Okay, so we will continue our discussion with regards to long-term assets. Today we will focus on amortization. Yesterday we talked about purchasing assets and how different expenditures become part of cost of assets and stuff like that. We focused on land, we focused on buildings and equipment. Today we're going to talk about amortization. So what is amortization? Amortization is the process of allocating to expense the cost of a long-term asset. What happens is that once you have purchased the asset, now you will be using the asset to earn revenue. As you're earning revenue from that asset, you are going to allocate a part of that asset's cost into expense. That process is called amortization. So basically you're allocating cost of the asset over its useful life to the expenses, and you are writing that cost off every year. Land is the only asset that is not amortized. So the rest of the assets are amortized throughout their lives, throughout their useful lives. So what is a useful life? Useful life is an estimate of expected life of the asset. You have to, as an accountant, come up with a number based on historical facts or based on predictions from experts of how much is a useful life of this asset, of all assets. Then there is salvage value. Salvage value is the estimate of an asset's value at the end of its useful life. So you are coming up not just with the number of years that you think the asset is being used for, you're also looking at the value that this asset will be worth at the end of the useful life. And then there's net book value. Net book value, we've talked about this in the receivables chapter. It's the same concept. You're looking at original cost of the asset, the amount that you purchased the asset for, minus the accumulated amortization. So accumulated amortization basically is all the amortization expenses that you have used up to that point for that asset. So it is just basically an addition of all the amortization expenses for that asset. Accumulated amortization is a contra asset account. It is an account with a credit balance, and it appears on the balance sheet in the assets section. So how do you amortize an asset? Some of you may be aware of one or two of these methods. We're going to talk about three methods. There are three methods listed on this slide: straight line, declining balance, units of activity. Each method is acceptable under GAAP, under the old GAAP, under the new GAAP, and management must decide which method to use. The most used method, however, is straight line for simple reasons. First of all, amortization is an estimate. You have to think about the fact that you are using useful life, you're using salvage value, all of those things are estimates. So straight line is the easiest estimate to come up with. It is extremely simple to use, it is extremely simple to understand, and basically for users to understand, amortization sometimes can be tricky. Straight line can make it easier. So this is just a visual of how straight line works. You take cost minus salvage value, and then you get amortizable cost at the beginning of the year. You take that amortizable cost, you divide that by useful life, which is number of years, and you get your amortization expense. You see on the graph, right beside that formula, it's a straight line. Every year, the amortization expense would be the same amount. It will not change. Hence the word straight line. Then you've got declining balance. In the declining balance method, you're using a percentage. So you're taking the net book value, which is, as you know from the previous slide, original cost of the asset minus accumulated amortization, and you multiply that by the amortization rate, and you get an amortization expense. So as years go by, the net book value decreases. As net book value decreases, your amortization expense decreases because the percentage remains the same. So you can see it's like an asymptote. It actually never reaches zero, but it goes down close to zero as much as possible. And that's your declining balance method. Then you've got units of activity method. In the units of activity method, first of all, this method is basically used for machinery. You're looking at the units that this machine or this asset will produce in its life, and then the number of units it will be producing every year. So sometimes the number of units will be less in a given year, sometimes there will be more. So what happens is, as the number of units go up or down, the amortization expense also goes up or down, increases or decreases with it. So the formula is a bit more complex than the previous two. However, the concept is very similar. Look at the graph first. You see, in 1 year it's one amount. The next year it's a higher amount. Then it goes down and goes up and so on. So now let's look at the formula. You're looking at cost minus salvage value. You take that divided by the total number of units of activity that you're expected in its life. Now you have amortizable cost per unit. You take that per unit cost and you multiply that by the units of activity during that year, right? So, and then you come up with the amortization expense. So in 1 year, if you've got 5 units, and in the next year you've got 20 units, you can see that amortization expense in 1 year would be less, and the next year it will be 4 times as much. How do you record amortization? So as I mentioned, accumulated amortization is a contra asset account. Amortization expense is an expense account, and the amortization expense is simply debited to amortization expense of that asset, and you credit that same amount to accumulated amortization. You do not credit it to the asset. The asset's purchase price remains the same, and then what happens is, as you are calculating the net book value, you take away the accumulated amortization expense. You take away the accumulated amortization amount, and you come up with the net book value. So the entry is simple: debit amortization expense, credit accumulated amortization. Let's go through an example. This example will discuss all 3 methods. So in this example, you purchased a machine for $9,000 and installation cost of $1,000. So remember from yesterday, the cost of the asset will now be the addition of this. It will be $10,000. Useful life is 4 years. Salvage value is 0. The rate of amortization is 20%. It can produce 2,000 units in year 1, 4,000 units in years 2, 3, and 4. So I've given you information to calculate amortization expense for all 3 types. You can see straight line method, 10,000 minus 0 divided by 4 years, 2,500 per year. So debit amortization expense, credit AA, which is accumulated amortization, $2,500 a year. In the declining balance method, you're taking 10,000 times 20%, which is 2,000. In the next year, 10,000 minus 2,000 times 20%, which is 1,600. Year 3, 10,000 minus 2,000 minus 1,600 times 0.2 equals 1,280. So you can see the amortization expense would be different, 2,000, 1,600, and so on, depending on the year. Units of activity. Let's look at that formula. 10,000 minus 0 divided by 2,000 plus 4,000 plus 4,000 plus 4,000. This is all the units that the machine will produce in 4 years. You come up with 71 cents. You take that 71 cents times by 2,000, you come up with $1,428. Year 2, take the same 71 cents, but now multiply by 4,000. You come up with $2,800. So amortization expense would be consistent with those amounts. Now what happens when you are going to try to get rid of an asset? There are 3 ways of disposal of long-term assets. You can retire the asset, which means throw it out. You can sell the asset, or you can exchange the asset. In the year that you are disposing the asset, you have to do a transaction to take that asset out of your balance sheet, because you're looking at basically disposing that asset. So there are 4 steps that you must follow, as you can see. Step number 1, you record the partial year amortization. Debit amortization expense, credit accumulated amortization. You record this right away at the time that you're going to sell or dispose of the asset. Second thing you do is calculate net book value at that point. So now that you've recorded the amortization expense for that partial year, you would have an exact accumulated amortization, and you can get an exact net book value by taking away accumulated amortization from original cost. Then what you do is you compare the net book value, which you just calculated, to proceeds of sale for the actual amount that you're selling the asset for. If the proceeds of sale, which is the sale price, is greater than net book value, you have a gain. You've made some money. If the proceeds is less than net book value, you have a loss. You can now record the disposal of the asset. If there was a gain, you would take debit, you would take the cash and debit it, which is the proceeds of sale. Which is the proceeds that you received. You would also debit all the accumulated amortization, because you're getting rid of the asset, so you are making that accumulated amortization to a balance of 0. You credit the asset amount, the purchase price of the asset, and you credit the gain on asset disposal because you had a gain. Remember, gain is revenue. However, if there was loss, everything would be same except that the gain would not appear. There would be a loss, and a loss would be a debit. Loss is like a negative revenue, right? So you would debit the loss. So this is a complicated entry. I don't expect you to memorize these entries. I expect you to understand them, the process and the entries, and hopefully as you do chapter 10 assignment, you'll do practice questions as well. You will understand the procedures and steps involved in that. So we'll stop it here, and then we'll continue with intangible assets tomorrow. Thank you.